Standard Deviants present The Wild and Wacky World of Finance, starring Jeremy Clavens, Gabrielle Smith, Tessa Monroe, Dina Rubinson, Malcolm Smith, Herschel Bliefeld, Brad Aldis, Leela Azrez, and Merritt Hicks.
If you have 5 stocks or less, you have a lot of risk. But if you buy a bunch of stocks, diversify, you can get rid of some risk. This kind of risk is called company-specific or unsystematic risk. This is risk based on a company's own potential problems or situations like strikes, management, or poor financial strategies. Company-specific risks can be diversified away because they can be offset by events at another company in which you own stock.
Remember, market risk is the risk that all companies have because of factors in the economy and the market. Company-specific risk is based on the company's own specific risk through operations. Since most company-specific risk can be diversified away, most investment models measure market risk and use that to help investors. The models also assume investors are risk-averse, and so the models attempt to determine how to get the most return for a certain level of risk.
The tendency of a stock to move with the market is an important concept. We will now examine this closely and relate this back to the capital asset pricing model, the formula we will use to determine the appropriate rate of return for a stock based on its risk relative to movements in the entire market.
Section C, beta.
A key element of CAPM is beta, also known as the beta coefficient.
Beta is a measure of the volatility of a stock in relation to some portfolio. In our case, it's a really big portfolio we call the market. When discussing beta, it is important to remember that we are talking about how a stock moves relative to the movements of the market.
Remember, at a certain point you cannot diversify your portfolio's risk away. So even a portfolio as large as the entire New York Stock Exchange still carries the market risk with it. Take a look at this graph.
This graph draws this concept for you. The yellow is company-specific risk, and the pink is market risk, the risk you can't get rid of. On the x-axis, you have an increasing number of stocks in the portfolio, and on the y-axis, you have increasing risk. We rated their risk by using their standard deviations. As you can see, when you increase the number of stocks, you gradually decrease the risk because you are diversifying. Eventually, you get to this point when diversifying doesn't reduce the risk anymore. That's the same level as the market risk. See? You just can't get rid of that pesky market risk.
You cannot change the market risk. It's always there. The market fluctuates just like stocks do. The market as a whole moves up and down based on changes in the economy, or with a major impact like a war.
There's something that I would like to emphasize in case it is confusing you. When we estimate market risk, we use an estimate of the risk of the entire New York Stock Exchange. We can substitute a portfolio the size of the New York Stock Exchange for the market because the NYSE is composed of the largest, most actively traded stocks in the country from many different industries. Company-specific risk of any individual stock is diversified away to the point that the only risk we can find is equal to market risk. When you put all of the companies in the NYSE together, you eliminate company-specific risk to the point of the market average. This leftover risk is also called the undiversifiable risk. Makes sense, doesn't it?
The important thing is for you to understand the concept of beta. Although you could calculate beta, it'll normally be supplied for you in your class. To calculate beta, you need this big, huge computer and a bunch of programs, and it's just a real pain. And then there's a bunch of brokerage companies that publish beta, so why not get it from them? So I guess what I'm trying to say is, know how to use beta, but don't sweat calculating it.
Now that you know you won't have to calculate beta, let's talk about the values of beta, which you'll be given. The beta of the market is equal to 1. 1 exactly. If the individual stock you're looking at has a beta equal to 1, then it has the same exact amount of risk as the market. However, If a stock has a beta greater than 1, then that stock is more risky than the market. And if a stock has a beta of less than 1, then that stock is less risky because its risk is lower than the market.
Here you see a listing of betas for some of your favorite companies in the real world out there. As you can see, most betas range from 0.50 to 1.50, with the average being 1. Why is the average 1? Because the market beta, or average beta of the market, is 1.
Since the market beta is 1, a beta of 0.5 is a low-risk stock. Our earlier example of a water company, H2O Co., has a beta of 0.6. It is a public utility, and it has little risk. In all states of the economy, people need water. Therefore, the H2O Co. stock does not fluctuate as much as the market as a whole. This is where beta comes in handy. Beta is a true measure of a stock's risk, rather than the standard deviation, because it is measuring the stock against the market risk. Standard deviation, if you remember, just gives you the measurement of your individual stock's risk. Since you have a portfolio, you don't care about individual risk because most of it has been diversified away. In essence, beta is a measurement of a stock's relevant risk because it gives the investor a specific measure of risk compared to the market.
Beta is also crucial because it tells you how much the risk of your portfolio increases with the addition of a new stock. If you have a portfolio of stocks equal to the market portfolio with a beta of 1, and you add to it a stock with a beta of 1.90, you are increasing the risk of your whole portfolio. However, if you add a beta with a portfolio of 0.6, like H2O Co., you are lowering the risk of your portfolio. With a portfolio of stocks, you can determine the beta of the portfolio by taking a weighted average of the betas of the stocks in the portfolio. Let's look back at the $1,000 portfolio we had before, the one that had H2O Co., Nuggets, and Porkers.
The investment in H2O Co. totals $400, or 40% of the portfolio. Nuggets totals $300, or 30% of the portfolio. And Porkers totals $300, or 30% of the portfolio. H2O Co. has a beta of 0.6, and let's say that Nuggets has a beta of 1.8, and Porkers has a beta of 2.2. To get the portfolio beta, you multiply each beta by its weight in the portfolio and add them up. 0.4, the weight of H2O Co., times 0.6, H2O Co.'s beta, plus 0.3, Nuggets weight, times 1.8, Nuggets beta, plus 0.3, Porkers weight, times 2.2, Porkers beta, compute, equals 0.24 plus 0.54 plus 0.66. Kerchunk, equals 1.44.
The portfolio beta is 1.44, and this portfolio is riskier than the market because every time the market moves 1 point, your portfolio moves 1.44. That's good if the market goes up, but really bad if the market goes down. As you can see, betas of particular securities dramatically affect the betas of a portfolio. Beta is an important measure of a stock's relevant risk as compared to the market risk. Therefore, intelligent investors use a stock's beta as a measure of a stock's risk relative to the market portfolio of stocks.
Now that we understand beta, we can get serious about CAPM, our model for establishing the appropriate return needed on a stock.
Section D, putting CAPM to work for you.
CAPM.
We need to put CAPM to work for the investor.
What an odd statement that was.
We've seen that beta is the real measurement of risk that an investor needs to focus on because it tells that investor what risk his investment has in comparison to the market risk. Now we need to tell investors what type of return they should expect for taking that risk.
The capital asset pricing model allows an investor to determine what return he or she should receive on an investment per level of beta or level of risk. This is also known as the required rate of return because it is the rate an investor will require to invest in that stock. To figure out the required rate of return on an investment using CAPM, you need several components: the beta of the stock, the risk-free rate in the market, which as we discussed earlier is the short-term interest rate of U.S. Treasury bills, and the expected return on the market. The average return of stocks in the market is measured by a major index like Standard & Poor's 500.
I'm just a peaceful little frog reading the Wall Street Journal. Oh, what a glorious day. Oh no, it's the staple guy! Ah!
The formula for CAPM is the required rate of return for an individual security, K sub S, is equal to the risk-free rate of return, K sub RF, plus the beta coefficient of the stock, times the expected market return, K sub M, minus the risk-free rate of return, K sub RF. Got it?
Now remember that the whole idea of CAPM is that most investors are risk averse. So, CAPM determines how much return a risk averse investor requires for a certain amount of risk.
What you are doing is adjusting the expected return of an individual stock for the risk inherent in the market. If you remember, portfolios of stocks can only diversify away company-specific risk, not market risk. You cannot get rid of market risk, so you have to adjust for it. The difference between company and market risk is a risk which you want to be compensated for. Risk that is calculated by beta, the risk of that particular investment compared to the risk of the market as a whole. Confused? Here's the important part. The capital asset pricing model adjusts the rate of return based on how risky an individual stock is relative to the market.
This next part is kind of confusing, so prepare yourself.
The market's overall average risk minus the risk-free rate, or the rate on a T-bond, is called the market risk premium. The market risk premium is the risk that the market, not your individual investment, requires above and beyond the securities that have no risk. The market risk premium, when multiplied by an individual stock's beta coefficient, gives the investor his or her particular risk premium on that particular investment. The risk premium is the percentage above and beyond the risk-free rate that the investor will require to invest.
So if Joe Average is going to buy a specific stock, he wants a return over the risk-free rate of at least the size of the risk premium.
The final step of CAPM is to add the risk premium to the risk-free rate, or the T-bill rate. And that, my friend, gives you the required rate of return. Some professors use the T-bond for the risk-free rate, so keep your eyes open.
Please tell me this is important.
Of course it is. I'll use an example to demonstrate. Let's suppose that the current risk-free rate on a long-term Treasury security is 6%. The current average stock market return is 12%, and you are interested in investing in a company called Therapets.
This company is a national chain of pet psychiatrists. The beta for Therapets is 2.6. We got that number from an investment magazine. Because of this beta, we can tell that this company is much riskier than the market. But what return percentage should we require if we make this investment? Use the CAPM formula.
The required rate of return for Therapets is equal to the risk-free rate of return plus the beta coefficient of the stock times the market risk premium.
The rate you require is equal to the risk-free rate plus the beta times the market risk premium. Fill in the blanks. K sub S is equal to 6 plus 2.6 times 12 minus 6. 6 plus 2.6 times 6. 6 plus 15.6. 21.6. The required rate of return for Therapets is 21.6. So, because we're such frumpy, risk-averse investors, we would require a very large rate of return on this risky investment.
And that, ladies and gentlemen, is the CAPM formula. CAPM allows you to find the rate you require to make an initial stock investment. It doesn't mean you will be offered the proper or necessary rate, but it tells you what you would require in consideration of the investment. Because CAPM calculates the required rate of return, it's a very useful tool for financial managers.
I think the best course of action here would be to start you on some lithium. Would that be okay? Yeah.
Section E, the security market line.
The one thing left to discuss about CAPM is the security market line. The security market line, or SML, graphically depicts the capital asset pricing model. The SML graphs CAPM. Remember, the CAPM formula looks like this.
The required rate of return equals the risk-free rate plus beta times the market risk premium.
With the security market line, we can graph Therapets, our earlier example, and you'll be able to visualize its required rate of return relative to other points on the SML. In our Therapets example, we said the average market return was 12% and that the risk-free rate on a long-term treasury security was 6%.
We first must begin to construct the security market line. Come on, I'll walk you through this.
As you see here, the required rate of return goes along the y-axis, or vertically, and beta goes on the x-axis, or horizontally. On the y-axis, we have rates of return going from 0% all the way to 25%. On the x-axis, we have beta starting at 0 and going all the way to 3.0, or 3 times the market beta. As we said, the risk-free rate is currently 6%. Find 6% on the y-axis and draw a point. At this point, we need to draw a horizontal line all the way across the graph. Why? Because everything below this line, in pink, constitutes the risk-free rate. Nothing will be plotted below this area because all securities have returns at least as great as the risk-free rate. So the y-intercept of the vertical line at 6% is the risk-free rate.
To develop our SML further, we need to plot the value of the expected return on the market. Remember, from our earlier discussions, that the market beta equals 1. Find 1 on the x-axis. In this example, the average market return is 12%. Find 12% on the y-axis. Draw a point where these two intersect.
The beta of Therapets was 2.6. Using the CAPM formula, we determined that the required rate of return for Therapets is 21.6. If we now plot this information on this graph, we can construct the security market line.
To plot Therapets on the graph, first, find its return of 21.6% on the y-axis, and find its beta of 2.6 on the x-axis. Draw a point where those two intersect.
Now you can begin to see a diagonal line forming. This is the security market line. To develop the line some more, let's plot another company's return on our graph.
How about Happy Landings? No objections? Okay. Happy Landings has a beta of 3.0, but to plot it on our graph, we need to determine its required rate of return. How do we do that? With the CAPM formula. Risk-free rate plus beta times the market risk premium. 6, the risk-free rate, plus 3.0, Happy Landings beta, times 12, the market rate of return, minus 6, the risk-free rate. So that's 6 plus 3 times 6, or 6 plus 18. The required rate of return on Happy Landings is 24%. Now plot this value on our security market line graph. Find where Happy Landings beta of 3.0 and required return of 24 intersect. They intersect here.
Now you can see the security market line. It's this diagonal line which graphs the relationship of risk and return, with risk being represented by beta and return as the expected return. Once you have plotted enough securities on the graph to draw the security market line, you are able to use it to value securities by their beta alone. If you were given the beta for a particular security, you can move up to the SML and then move horizontally over to the y-axis to find out how much return you would want for the risk.
As you can see from the work we have done, the security market line can be used to price securities graphically. The security market line is used to determine the expected return on an individual security based on a risk-free rate and a risk premium. It graphs CAPM.
Now let's see how changes in inflation affect the security market line and rates of return in the marketplace. Inflation will merely shift the line upward. It will not change the slope of the line. Why? Because inflation affects all parts of the SML equally. Inflation affects not only the rates of return on the investor's stocks, but on the market as a whole, including the risk-free rate. So, as prices rise, the whole line shifts upward.
Look at the example which we just graphed. If expected inflation increases by 2%, the risk-free rate increases by 2% to 8%, and the expected return of the market increases by 2% also, from 12 to 14. You can easily visualize the reason for an upward shift when you plug the new inflation numbers into the CAPM formula.
Using CAPM, you can see that before the inflation increase, a stock with a beta of 1.5, like our Heavenly Tattoo, had a return of 15%. After the 2% inflation increase, plug in the new numbers. The 6% risk-free rate is now 8, plus the beta of 1.5, times the expected market return of 14, minus the risk-free rate of 8. This equals 17%. So as you can see, because all parts of the equation are affected equally, the line merely shifts upward. Our Heavenly Tattoo has a beta of 1.5 and a return of 17.
You may be thinking, what would cause the line to get steeper or the slope to change?
The only way the slope changes is if investors in the market as a whole become more or less risk averse and require greater or less return per unit of risk. As investors become more risk averse, they will want more return per unit of risk. Therefore, the return on the market, or KM, increases while the risk-free rate, or KRF, stays the same. The risk-free rate does not change when there's more risk because it's the risk-free rate. Duh!
Let's give you an example. If the risk premium of the market increased 3%, from 6% to 9%, the required return on Therapets would increase. Let's look at our graph from before with the numbers from Therapets on it. As you can see, when the market return was 12%, Therapets had a return of 21.6%. However, when you increase the risk premium by 3, using the CAPM formula, you can see an increase in the rate of return to 29.4%. The interesting thing to point out is that the risk-free rate hasn't changed. Investors are becoming more risk-averse because they're demanding a higher return for the same amount of risk. See the new SML. The slope has now changed.
So, to sum up, the inflation will cause a shift in the security market line, while the change in the risk averseness of investors will change the slope of the security market line.
The capital asset pricing model allows investors to determine the required rate of return for a given security. This equation, K sub S, equals the risk-free rate plus beta times the market return minus the risk-free rate, can be depicted in the security market line. The security market line allows investors to graphically price securities. Inflation will cause an upward shift in the SML, but won't change the slope. Come swim with me. I'm Mr. Fish.